Japan's bond market just made its biggest move in Nishiju years. On Monday, the yield on Japan's 10-year government bond hit 2.10%, the highest level since July C2 Pai Q cent. That's not just a number. Japan's government bond market is the second largest sovereign debt market on the planet. When it moves like this, everyone pays attention.
And the reason it moved starts with a failed peace summit in Islamabad, a U.S. Navy blockade, and a narrow stretch of water in the Persian Gulf that Japan can't afford to lose access to.
This is the Japan factor. Let's run the tape. Over the past several weeks, the United States and Iran had been negotiating a ceasefire after the conflict that began in early Nullah and shut down traffic through the Strait of Hormuz. Those talks collapsed. On April 12th, the U.S. Navy announced a full blockade of Iranian ports. The next day, Brent crude surged past $40 a barrel, a gain of 60% since the start of the conflict.
At its peak on April 8th, Brent spot price touched $by low by dollar per barrel. Oil markets are now in full crisis mode.
Japan's bond market registered the shock immediately. The 10-year JGB yield rose to 2.4% on April 14th, up 0.4 basis points in a single day. The 5-year yield hit a record 10.5%. Bond prices move inversely to yields, so what you're watching is investors demanding more compensation to hold Japanese government debt. They want a higher return because the risks just went up.
To understand why a conflict kilometers away can move Japan's bond market by its largest amount in nearly 3 decades, you need to understand something fundamental about Japan's economy.
Here's the number that explains everything: 94%. That's the share of Japan's crude oil imports that came from the Middle East as of January 2024. According to Japan's Agency for Natural Resources and Energy, approximately 97% of that oil transits through the Strait of Hormuz. Some estimates put that figure even higher, closer to 96% of all Japanese oil imports passing through that narrow bottleneck.
Japan generates almost no oil domestically. The country imports roughly 80% of its total primary energy. Every factory, every bullet train, every convenience store, they all run on energy that has to be shipped from the other side of the world through one of the most contested waterways on Earth.
When Iran's oil minister Nissan Arslan described the Strait of Hormuz as the world's most important energy choke point, he wasn't exaggerating for effect. For Japan, it's an existential artery.
Compare this to Europe. Germany imports oil from Norway, Russia, and multiple Middle Eastern sources across different routes. The United States now exports more oil than it imports, but Japan has almost no such redundancy. Researchers at Energy Tracker Asia ranked Japan highest among all major oil importing countries for Hormuz disruption risk. A vulnerability score of Liu Tern C out of C Tern C out of C Tern C for C Fee True Tern C out of C Tern C for C Fee True Tern 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 C Fee.
Now add one more layer: the subsidy removal. On April 1st, exactly as the Hormuz crisis was intensifying, the Japanese government ended its energy subsidies. These were introduced in Nishiju to shield households from the first wave of post-pandemic energy price inflation. They kept electricity and gas bills artificially low for nearly 4 years. Now they're gone. Electricity bills for Japanese households are expected to rise due to 60% from subsidized levels. For a typical household, that could mean an extra $50 per month.
The timing couldn't be worse. Japanese households are now facing a double hit: market rate energy bills colliding with an oil price spike driven by a Middle East crisis. Bloomberg reported in March that if crude stays in the $60 range, Japan's annual trade deficit could widen by nearly trillion yen, roughly $600 billion.
Japan's February trade surplus had already collapsed, from 42 billion yen a year ago to just 42 billion yen as imports surged 13% year-on-year.
Imports, not exports, are driving the change.
This is where it gets complicated. Japan's central bank, the Bank of Japan, is scheduled to meet on April 27th and 28th. Before the Iran talks collapsed, markets were pricing in roughly a lucrative % chance of a rate hike at that meeting. An ex-BOJ official had told Bloomberg on April 8 that a hike was likely. Japan's Nisen Nisruksunto wage negotiations, the annual spring wage talks between unions and major employers, came in at around 5%, the highest in 3 decades. Real wages surged 2% year-on-year in February. All the data pointed toward normalization.
Then oil happened. BOJ Governor Kazuo Ueda delivered a speech on April 13. His words were careful, almost diplomatic. Global financial markets are unstable, he said, and crude oil prices are rising sharply due to Middle East tensions. We must be vigilant to future developments.
He flagged the dual nature of oil's impact on Japan. Higher oil prices push up energy costs and drive inflation, which would normally argue for rate hikes, but they also crush real incomes, hurt the trade balance, widen the output gap, and slow the economy. Fighting inflation by raising rates while the economy is simultaneously being strangled by an external shock is not a straightforward call.
Markets recalibrated immediately. On Poly Market, the implied probability of no change at the April 27-8 meeting jumped to %. The question is no longer when does the BOJ hike, it's can they hike it all right now without making things worse.
And that's why the bond market is reacting the way it is. When investors see a central bank that can't raise rates to fight inflation because the economy is being simultaneously crushed by an external shock, they start to worry about the longer-term fiscal math. Japan's government debt-to-GDP ratio is approximately 0%, the highest in the developed world. The fiscal Nisen Nisluk budget is a record back niche diartan san trillion yen, roughly 9%, the bullion, and debt servicing costs alone hit a record santri itan trillion yen, or about 1/4 of the entire budget.
The Finance Ministry's own projections show debt issuance surging % by fiscal Arsen with debt servicing costs potentially hitting san trillion yen, nearly 1/3 of total expenditure.
An oil shock that prevents rate normalization, combined with a record budget funded by more borrowing, is exactly the scenario that sends bond yields higher.
Nomura Research Institute modeled it: if oil reaches $200 per barrel, Japan's GDP contracts by 10 percentage points within a year, and inflation rises by 10%. The IMF's base forecast for Japan in Nisen Nisruk is already just 10% growth. There is very little cushion here.
Here's the one counterintuitive angle worth flagging: not everyone in Japan loses. Warren Buffett's 5 major sogo shosha positions, Itochu Marubeni, Mitsubishi Corporation, Mitsui and Sumitomo, are commodity trading conglomerates with massive exposure to energy and resource prices. Berkshire Hathaway's Japan stake is now worth an estimated $6 billion. When oil rises, trading houses that sit at the center of global commodity flows tend to profit. Mitsui and Mitsubishi are both heavily invested in air energy. Mitsubishi completed a trillion yen share buyback as recently as March 25. The trade houses are, almost accidentally, a partial natural hedge against the very energy shock battering the broader Japanese.
If Buffett noticed that irony, he hasn't commented publicly. Japan has enough strategic oil reserves to last 4 days, nearly 3 times the International Energy Agency's minimum requirement of shosha days. Prime Minister Takaichi has already authorized a release of 500,000 barrels from those reserves as part of a G7 coordinated response, with a possible additional 20-day release in May. There is real buffer here, and Japan has been through oil shocks before. Senchu haksesed ju fortutin, it always finds a way.
But the structural problem remains. Japan is the world's 3rd largest economy and one of the most oil-dependent major nations on Earth.
When a waterway it has almost no influence over closes, Japan doesn't just feel the pinch, it registers it in bond yields, trade figures, household bills, and central bank meeting outcomes.
The April 27 2H BOJ meeting is now the most important near-term data point to watch, not just for Japan. If the Bank of Japan signals it cannot normalize policy because of external energy disruption, it's telling global markets something important, that the post-zero rate era has real limits, and that geopolitical shocks can override central bank timelines even when the domestic economic data looks strong.
Japan is, in this sense, the world's most legible stress test for how developed economies handle energy dependence in an era of fracturing geopolitics.
What happens in Tokyo over the next 2 weeks will tell us a lot about what comes next everywhere. I'm watching the April 27th decision. You should be too. Word count, seiyonfai kushitsi words, estimated duration, moner spree minutes format news flash.